We're going to chapter 28 in economics, consumption. When we talk about consumption, it simply means spending on goods and services. That is what consumption is about. So like I said, consumption is all about spending on goods and services. So consumption can also be classified as spending on durable goods and non-durable goods. So why do we call them durable goods? We call them durable goods because these goods can last for more than years. For more than a year. That's why it's durable. Like they can last longer, like cars, houses, buildings, equipment. They can last more than a year. So when you spend on them, it is still consumption. Then we have non-durable. These goods are goods that are expected to be used up as soon as now, or they have a short period of time to be used, like food. Yeah. So these are the difference between durable and non-durable goods. But whatever the case might be, spending on them, either durable or non-durable, is still consumption. Is it clear?
Mm-hmm.
Any question about consumption there?
Mm-hmm.
Good. So that takes us to saving. When we save, it means the amount of money that we didn't spend. That is what saving is about. Do you get the point here? So saving is what? Saving, this is what is not spent on income. So the amount of money you have that you didn't spend on consumption is called saving. I think saving is clear. That takes us to disposable income. Why do we call it disposable income? Because whatever we consume, we can't consume without income. So our income, the level of income is determined by, the level of consumption is determined by the level of income. So that's Keynesian theory of income anyway. So we won't talk about spending without talking about disposable income. So what is disposable income? Disposable income is that income after tax. Any income after tax. That means you've paid your taxes. So the income that is left is called disposable income. So a disposable income is that income that you can either spend or save. Is disposable income clear there? Mm-hmm. Good. So that takes us to consumption function. Consumption and disposable income. Are you there?
Yes.
So when I talk about consumption function, I wrote, this is the relationship between consumption and factors that determines how much a household can consume based on the level of income. So that is what consumption function is. The relationship between household income, and that means the extent to which they can consume based on their income. That is consumption function. Do you get that? Mm-hmm. So for consumption function, we have the marginal propensity to consume, which is a change in consumption over change in income, MPC. Are you with me, please?
Yes.
So here I go. The MPC this is for marginal propensity to consume. I go. This is the proportion of a change. This is the proportion of a change in income that is spent. The proportion of a change in income that is spent. So that is why MPC is change in consumption over change in income. So as soon as your income level changes, the consumption is expected to change. Do you get that? Yes. So MPC is change in consumption over change in income. Change in consumption over change in income. So where C is consumption and Y is level of income. I think that is clear. Have this, please. So we have average propensity to consume, APC. For average propensity to consume, it simply means the average amount of money spent on consumption as part of your total income. The average amount of money you spend on consumption out of your total income. That is APC, average propensity to consume. So the formula for APC is consumption over income. That's APC itself. But for marginal propensity to consume, it is change in consumption over change in income. But average propensity to consume is consumption itself over income. You get the difference here, okay? So then we have the Keynesian. So I wrote here, the Keynesian theory of consumption states that income is the most important determinant of consumption. So the Keynesian, they believe we won't talk about consumption without income. So income is the most important determinant or factor that leads to consumption or leads to consuming or spending. So according to the Keynesian, as income grows, households would prefer to save more, which means the APC would decline. So according to Keynesian, as soon as your income level increases, you tend to save more. Then because you are saving more, then your average propensity to consume would decline, would reduce. Because your APC is the average amount of money you spend in your total income. Now that your total income is increasing, you spend less. That means your average propensity to consume will decline. Do you get the point here, please? Okay. Also, higher income earners save more of their income than poorer households. Therefore, redistribution of income from higher income earners to lower income earners through taxation may increase consumption. So for consumption to increase, it would have meant that there's redistribution of income from high income earners to low income earners. And that means through government taxation, maybe progressive tax. So that reduces the gap between the rich and the poor. And as soon as there's redistribution of income, then spending would increase. Because poor income earners, they spend less. They spend more on consumption. And they can only spend more on consumption if they have access to more money. So that means income has to increase for them before they will be able to spend more on consumption. But as soon as the gap between the rich and the poor reduces, spending or consumption increases in the economy. Is it clear? That means. So we'll go to other influences now. So that is about income. But income is not the only reasons why people spend. There are other reasons why people might be able to spend. So one,